The ties between Mexico and China are reshaping trade, manufacturing, and economic power in North America. This seismic shift is more than a headline. It could redefine your understanding of global trade dynamics. Mexico has long been a key economic partner for the U.S., with deep ties built through agreements like NAFTA and USMCA. But the growing influence of China in Mexico's automotive and EV industries signals a turning point. Investments worth billions are transforming Mexico's global role, challenging the U.S. to rethink its strategies. Here are 7 key factors driving this shift and what they mean for the future. If you're invested in understanding global trade or the future of EVs, hit that subscribe button. Let's break it all down. 7. Mexico's growing independence from the U.S. For decades, Mexico's economy has been deeply tied to the U.S., benefiting from trade agreements like NAFTA and its successor, the USMCA. These deals fostered economic integration, making the U.S. Mexico's largest trading partner. But times are changing. From 2018 to 2023, China invested $2.3 billion in Mexico across sectors like automotive and infrastructure, including $150 million in 2023 alone. This diversification reduces Mexico's reliance on U.S. markets while boosting its international influence. For Mexico, these changes represent greater autonomy. For the U.S., it's a wake-up call about shifting alliances and economic strategies. The benefits for Mexico go beyond economics. Political and trade diversification allows Mexico to mitigate risks associated with relying too heavily on one partner. The growing independence also positions Mexico as a more influential player in Latin America. As Mexico asserts itself, the U.S. will need to consider how to maintain strong economic ties without appearing overbearing. 6. China's multi-billion-dollar investments in Mexico. China's financial footprint in Mexico is substantial. In 2023 alone, China poured $2.72 billion into Mexico's automotive sector, accounting for nearly 3/4 of its total investments in the country. These funds go beyond production lines. They include research and development, workforce training, and supply chain improvements. For Mexico, this means economic growth and new opportunities, especially in the electric vehicle (EV) industry. But for the U.S., Chinese factories close to its borders spell heightened competition. If Chinese automakers use Mexico as a launchpad for tariff-free exports to the U.S., they'll disrupt the North American market. To maintain its edge, the U.S. must rethink its approach to trade and regional partnerships. China's strategic investments are also modernizing industries in Mexico. Beyond EV production, advancements in robotics, artificial intelligence, and material sciences are reshaping the manufacturing landscape. These changes enhance Mexico's competitiveness globally while raising questions about the long-term influence of Chinese companies. 5. The lithium boom, China's stake in white gold. Lithium is critical for EV batteries and renewable energy. Mexico's vast reserves make it a significant player in the global lithium race. In 2023, Chinese company JG Yang secured a 20-year liquefied natural gas (LNG) deal with Mexico Pacific, signaling deeper collaboration on resources. By securing lithium supplies, China strengthens its position in the EV market while influencing production costs. For Mexico, these agreements promise economic gains. However, they also demand oversight to protect local interests and prevent overdependence. Meanwhile, the U.S. faces the risk of falling behind in the race for essential EV resources, adding urgency to its strategy. The environmental and social impacts of lithium mining in Mexico must also be considered. Community protests and ecological concerns could influence the pace of development. Both Mexico and its foreign partners will need to address these challenges to avoid backlash that could derail projects. For Mexico is China's North American EV hub. The global pivot to EVs is undeniable, and China is positioning Mexico as its manufacturing base in North America. Chinese automakers like BYD and SAIC are setting up plants in Mexico to leverage its proximity to the U.S. and favorable trade terms. Mexico offers a skilled workforce and a robust automotive industry. By producing locally, Chinese firms bypass tariffs and cut shipping costs, making their EVs more competitive in the U.S. While these investments create jobs and drive tech advancements in Mexico, they also raise questions about impacts on domestic markets and trade dynamics. The U.S. must address these concerns as China's influence grows. This new role as an EV hub also brings challenges. Mexican infrastructure, from ports to highways, must be upgraded to support increased industrial activity. Additionally, the shift could strain energy resources as factories demand reliable, clean electricity. Addressing these needs will be critical for sustaining growth. 3. The U.S. strategic missteps in the region. China's rise in Mexico has been partly enabled by U.S. policy missteps. Tariffs, trade wars, and inconsistent agreements have strained Mexico's trust in its northern neighbor. Historically, the U.S. provided economic stability and opportunities, but recent actions have created cracks in this relationship. China, on the other hand, has approached Mexico with clear long-term plans and reliable investments. By filling gaps left by U.S. policies, China is positioning itself as a more dependable partner. If the U.S. doesn't adjust its approach, it risks losing influence in North America's evolving economic landscape. One key area of concern is the lack of a unified vision in U.S. trade policies. While China's Belt and Road Initiative offers clear benefits, U.S. strategies often appear reactive. To compete, the U.S. must prioritize consistent, mutually beneficial policies that reinforce its position as a reliable partner. 2. Mexico's role in global trade. Mexico's geographic location makes it a linchpin in global commerce. Positioned between North and South America, it's an ideal hub for international trade. Partnering with China amplifies these advantages. Through initiatives like the Belt and Road, China is upgrading Mexico's infrastructure with investments in ports, railroads, and highways. These developments are not only driving Mexico's economic growth, but also reducing U.S. dominance in regional trade. The alliance between Mexico and China is reshaping the balance of power in North America. Mexico's partnerships with other nations, including Canada and European countries, further underscore its importance in global trade. As China continues to invest, the ripple effects will be felt worldwide, challenging traditional trade hierarchies and creating new opportunities. 1. The emerging Mexico-China alliance. At the core of this transformation is the deepening partnership between Mexico and China. For China, Mexico serves as a gateway to the North American market. For Mexico, China offers technological advancements and economic stability. This alliance is redefining Mexico's position on the global stage. It's no longer just a regional manufacturing base, but an emerging economic force. As the U.S. watches from the sidelines, it must grapple with a North America where its influence is no longer guaranteed. The partnership has broader implications for geopolitics. By aligning with China, Mexico is signaling a willingness to diversify its alliances, potentially reshaping diplomatic relationships across the Americas. This could lead to a more multipolar global order where no single country dominates. The partnership between Mexico and China signals a new era in North American trade and manufacturing. For the U.S., it's a call to action. Adapt or risk losing ground. What's your take on these shifting dynamics? Share your thoughts below. And if you want to stay informed about global trade and automotive trends, subscribe to AutoEdge. Thanks for watching, and don't forget to like and share. See you in the next video.